the Biden wealth tax, which is like 25% of the appreciation of things that you own privately, it's going to bankrupt every startup. No one will ever start a business in America anymore, right? Because God forbid, someone puts money in your company at $1 billion valuation, all of a sudden you owe, if you own half the company, you owe $100 million in taxes that year. Those kinds of taxes, I think, are destructive. You don't have a tax policy that destroys the economy.
Bill, I am so excited for this. I've heard so many great things. I just told you I was messaging with Jackie Reese's, but heard so many wonderful things. So thank you so much for joining me today.
Well, I'm delighted to be here.
I would love to start. I've listened to many of your interviews before, and bluntly, I wanted to ask different questions. And so I want to start with, you went to HBS and then you founded Gotham. How was raising the first fund?
It was fun. It was a bit like blind dating. A lot of blind dates, not much success. But we had, I think we eventually saw well over 100 people, and we had 6 people ultimately say yes and give us money. And the 6 people totaled $3.1 million. Actually, $3 million. And my partner and I put up 100 together.
What worked? What didn't work? 100 meetings. There must have been some lessons.
So what was interesting is anyone who knew me as a kid wouldn't give us money. And the same went true for my partner, because they thought of me, the perspective was me as a high school kid or a elementary school kid or whatever. So I had no success with anyone I knew. But of the original 6, 4 of the 6 were in the Forbes 400 wealthiest people in America. So we went to people who were worth $400 million. We asked them for like $500,000. And that was a good strategy, actually. And what was interesting is the people who were entrepreneurs really liked the idea of backing a couple of young guys who were entrepreneurs. And I think that was a big part of the connection. And the pitch we made, so we said, look, we're not doing venture capital. We're investing in, public companies. We're doing, high, detailed due diligence. We have no track record, but we have a strategy that has an excellent track record. We're Warren Buffett devotees. And we said, look, we're putting all of our collective net worths in. We're missing out on the opportunity to go work at McKinsey or Goldman Sachs to do this. We've been successful up to date in everything we've done. I did well in high school, went to a good college, did well there. Got into Harvard Business School, had success in my job prior to business school. So we sold them on track record of life success, no experience, a lot of moxie. And you know what, if we fail, you're not going to lose all your money because we don't use leverage. Right? We're buying real companies at a discount to what they're worth, reasonably concentrated. And I think the psychic, actually, one of the interesting things that happened is my partner, David Berkowitz, said, Bill, unless we raise $3 million, I'm not going forward with you. And so we were stubbornly stuck at like 2.6. And it's like February. And we're like, look, if we don't launch by March 1, we're done. And when we went to see people, we actually wrote up a number of investment ideas. And we wrote up 4 companies. And one of the guys we went to see was the heir of a famous New York City real estate family. And he turned us down. But he invested in all the ideas. One of them was up 90% between the time we saw him. One was up 50, one like doubled. And like the short we recommended imploded. I mean, it was like an incredible thing. And he calls us up sheepishly and he says, look, I invested in your ideas and I felt it was morally wrong for me not to invest with you guys. And he gave us $500,000. And that was like the increment that got us over the $3 million mark, and we started.
And we made it to 3.1 with that check. I learned a lot from my first partnership. You mentioned David there. What did you learn about great partnerships from that first partnership with David?
So David was a great partner, and we remain really great friends. We don't see each other as much as I would like. We actually, the very, very beginning, we lived together. Kind of a funny story. I had worked for a company called General Atlantic Real Estate, which was the real estate private equity subsidiary of the well-known, kind of venture firm. It's something they disbanded over time. I worked there for the summer, and I got an apartment. They gave me a good deal on an apartment in a building at the address was 360 East 88th Street, and we shared the apartment. Keeping costs down at the very, very beginning of time. And kind of the funny story is, many, many years later, my daughter, my youngest daughter was in the building with the nanny on a way to a play date, and she said, she was here to see. It was Eloise Ackman here to see some other child in the building, and the doorman said, or the concierge or whatever they called it, said, "Oh, Ackman. There used to be someone named Ackman who lived in this building. Maybe 8 or 9 years ago. And would it be Bill Ackman?" And she said, "Yeah, Bill Ackman." And the guy laughed and laughed and laughed. Is he married?" And she said, "Yes." He said, "To a woman?" And she said, "Yes." So the two of us living together, they thought we were a couple. And it was because the building didn't allow singles to share apartments. But because I had worked for the landlord, they made the exception. Anyway, I don't know if it's relevant for your particular podcast, but I thought it was kind of a funny story.
I think it's hilarious that the doorman for probably a year thought that you and David were romantically involved. So
my point is, we spent a lot of time together. Okay. We originally officed out of that little apartment while we were raising money, and then we eventually got a real office. And the key thing is picking someone that you totally trust. And David is, one of the trustees or executors of trust, etc. And I do the same for his kids. So if you can work together, succeed together, go through some challenging times together, and still rely on the other for the most trusted things, that's a pretty good sign. So choose your partners carefully, but choose someone you totally trust.
I've had my trust broken before, and it's very damaging and hurtful. Can I ask you, do you start from full trust and it's there to be lost, or do you start from none and it's there to be gained?
Probably neither. But I would say I form a view of a person's character pretty quickly, and the vast majority of the time I've been right, with only a few disappointments, I would say. And the disappointments have been cases, in most cases, and there haven't been many, where my spidey sense had a little bit of concern, but I chose to ignore the gut instinct, right? The gut is actually part of your brain, as we've come to learn, I think, over time. And I think it's important to listen to it. And I've learned to listen to it a little more carefully. And by the way, it depends on what you're trusting someone with, right? The degree of trust required for someone to take care of a child or a parent versus someone to invest with, a small sum, a large sum, a bank, of different kinds of fiduciaries. So it depends on what kind of trust you need. But someone you're going to work with. So it kind of depends. But David is someone I was in the classroom with at HBS for basically a full year, and then spent a lot of time with him in the second year. I had a pretty good understanding of who he was by the time we went into business together, and I wasn't surprised by anything.
We mentioned trust. I didn't kind of plan on it going this way, bluntly, Bill. My father was the one who broke my trust and really hurt me. And so much of that actually shapes what I'm running from, which is him. I don't want to be him, and I don't want to be like him in any way. And I guess I think about it a lot. When you think about what you're running from, what do you think you're running from?
I don't know that I'm running from anything. I think I'm running toward things.
What are you running towards?
Greater happiness, self-actualization, great relationships, friendships, and what am I running away from? Maybe death, disease, So what do I want to minimize? The risk of something bad happening. And what do I want to maximize? Happiness. And where does it come from? Fulfillment, relationships, self-actualization, achievements, things like this.
Can I be blunt? You appreciate happiness when you have it. It's very hard when you're on a treadmill. You look back to sharing that apartment with David, having a $3 million fund. Now, if you could see yourself back then, you'd say you have everything I could have dreamed of and more. Do you appreciate that happiness when you have it?
Of course. And by the way, I've been consistently happy pretty much since birth. So I've had volatility in my career. I've had volatility in my marriage, and now I'm now married again. I've gone through challenging times. I've experienced sadness and loss and all those things. But I think the undergirding support here is happiness. I'm an optimist, and I'm a happy guy.
You mentioned on your interview with Shane Parrish, I was just listening to it on the run, you said about kind of nothing ever being a straight line up. When you think about like your line, so to speak, in terms of the trajectory, what was the biggest dip and what did you learn from that specific moment?
So I had a few dips. One of the biggest dips, which seems far away and like nothing now, but it was a very significant one, was in the Gotham Partners days. And that was when I wrote, in this case, a white paper on, it was called Is MBIA AAA, where I questioned the AAA credit rating of a bond insurer. This is about 5 years in advance of the credit crisis. And then I found myself, never before had I taken on a politically powerful, influential, big company. And I found myself under the gun, ultimately under investigation by Elliot Spitzer. Then the SEC followed suit, and then all the negative headlines, and then we were forced to wind down Gotham. It was certainly, as the headlines at the time called it, a fall from grace. So that was, I would say, big challenge number one. I would say big challenge number two, business-wise, was certainly the period beginning late 2015 through late 2017. And then in the midst of that, ending a marriage. So I've had a few like that, but I've been very fortunate. None of these things are really catastrophic versus a serious, health challenge, which I've not had and hope to defer forever if I can.
You said before that success is defined by how you deal with the failure. When you look back to, say, that fall from grace, so to speak, with Gotham in that time, and 2015 to 2017 in that patch, when the war's in process, what do you tell yourself?
I tell myself to make progress every day. The advice I give friends who go through similarly challenging moments, and I guarantee you that, in life, it's the rare person that doesn't go through a very dark period, is, well, number one, adequate sleep, proper nutrition. Exercise is a huge help during, build muscle during those periods of time and get in really good shape, because that, I think, psychologically is a boost. Surround yourself with people who love you, and then make sure each day you make progress toward digging yourself out of the mess. And that kind of progress, physical, mental, business, compounds. And it compounds at a pretty high rate. And it's not long before you look back 60, 90, 120, 180 days, and you've made massive progress. And one of the great things about America is, and I know you deal with lots of startups and venture capitalists, is that, failure is something that's can be, a lot of talented, some of the most successful investors in the world are ones that the first one didn't work, and that you can, there's plenty of capital available for people who are second-time founders, and the first one was not a successful exit. They quote unquote sold their company, but that might be slightly bad. That means that could mean they sold the furniture. It doesn't mean that Google bought them out at a 50x.
Bill, you and I are both tennis players. You're a set down, you're a breakdown. What do you tell yourself in that moment?
Don't let the past disrupt the future, right? Don't be upset that you double faulted, 30-40 at 4-5 in the set when you were up with 3, set points. Because that, if you just focus on that kind of stuff, it will distract you. And just, start with a blank sheet of paper. It's a new set, new opportunity, and rebuild from here.
So that's when the match is in progress. When the match is over and say, Gotham's wound down, I've beaten you in a tennis game, which is very unlikely, but take a hypothetical scenario. Do you do a post-mortem process? How do you learn from that process? And what does that look like?
Sure. So I don't know if I do a formal post-mortem, but there were a lot of lessons learned about the structure of Gotham Partners, of our first fund, and I learned some pretty valuable lessons that remarkably weren't learned by others. So Gotham, we started out investing in liquid public securities, and then we went back to investors, and we got the mandate to invest up to a third of our portfolio in privates, venture capital, real estate, etc. And a structure, a so-called side pocket type structure that enabled that. approach. And then inevitably the asset liability mismatch is what caused us to wind down, because we had a problem with where, I blame MVIA for intervening in a court case. But ultimately a merger that was critical to our success ended up getting held up on appeal, or held up by a judge, ultimately reversed on appeal, but that was sort of too late. And so the lesson from the Gotham experience was of the importance of liquidity, and that you shouldn't have an open-ended fund like a hedge fund where people can redeem capital and own liquid assets. And so we built Pershing Square to invest only in liquid large cap public companies, and it served us really well. Meanwhile, I've watched the rest of the industry, or many people in our industry, particularly in the last couple of years, suffer from precisely the same asset liability mismatch issues that we had back then. And, so we did learn some pretty important and valuable lessons, but those lessons were not exported to the rest of the industry because people had to make the same mistakes we made. So I guess for me, I always like to say experience is making mistakes and learning from them. And I spend a lot of time learning from mistakes. We talk a lot at the firm, not just about things where we bought something and went down and we lost money. We talk as much about missed opportunity, a situation that in light of our knowledge, experience, expertise, etc., that we should have exploited and made a fortune on. And perhaps we made only a small fortune, or made nothing because we didn't do the work. And so those kinds of mistakes can be, certainly in our business, as important. Missing Google can be as important a mistake, or maybe even a bigger mistake, if you will, than missing the next, like some other making a bad investment that doesn't work, I guess is my point.
Jason on your team told me about coupang, so at least you hit some winners.
That's some good ones. We've had some very good ones.
You've had some very good ones. What was the most recent miss that you've debated as a team?
Well, at Pershing Square, Netflix. So we took about $1 billion position in Netflix after the stock fell about 50%. And then, we're a long-term investor, but we learned information within a few months of the initial investment, i.e. the next quarter's results, that caused us to question our entire thesis in the company. And we exited and promptly lost, $400 million, something along those lines. So that was a more recent one. But I think what's not written about in our letters, but I consider, with respect to COVID, I had a very early view what the economic implications of COVID would be, or enough of an early view, month, 2 months, not more than that, that enabled us to make a fortune hedging COVID. I had a very similar view about interest rates, and we were completely ahead of the curve. And the mistake was not making that a bigger bet. We should have made $10 billion on hedging interest rate risk. Instead, we made $2.8 billion because we were a little timid. So some of the mistakes we've made, where we had a pretty, variant view that we were quite confident in, but we didn't put enough capital behind our confidence. So
how do you think, sorry, I'm fascinated. How do you think about position sizing? You always want more in your winners. You always want nothing in your losers. How do you think about position sizing?
So the way we think about it is we're willing to risk a certain amount of capital on any one investment. And so if you're investing in the world's most dominant music company, Universal Music, it has very little debt. It has a great market position, and you can predict the business with a very high degree of confidence, and you're buying it at a fair price. You can assess what's the chance of our losing 25% of our investment, over a several year holding period. And if the answer is very close to zero, which is kind of our assessment, we can make an investment like that quite large, right? If you think about, well, if we're risking let's say the most we could lose in our view on that, not just a daily mark-to-market loss, but a permanent impairment, what would have to happen for us to be permanently impaired to lose 25% of our capital in that investment? Something pretty extraordinary. So that kind of investment can be 25% of our assets, because it's something where the risk of loss is very diminished by virtue of the robustness of the business, the capital structure of the company. Whereas you're buying an interest rate derivative, we bought, in effect, the way to think about it is we bought a call option that paid off when 2-year interest rates went above 93 basis points. And we had about an 18-month term. And at the time we bought that instrument, 2-year rates were at 12 basis points. So it's a bit like buying a call option on a stock. The stock is 12 and the strike price of the call option is 93. it looks massively, massively out of the money. And there's a fixed time frame, right? So on something like that, the risk of loss is high, because just to break even, you've got to cross, the yield, if you will, has to go up, whatever, 9x or something, right? 8x to get into the break even territory. And so something like that we make quite small. It was about 1.5 of our, a little under 2% of our capital. But could it have been 3%? Could have been 4% for sure. And so when I look back at something like that, I would have been willing to lose more, but we had not been an active participant in the interest rate derivatives market, so we were a little timid. Timidity has held back our results for sure. And I think what's interesting about those kind of bets is when you find a hedge that will protect you if rates rise, but it's also a really interesting investment on a standalone basis. Like you'd make it even if you didn't own a portfolio, because you said, look, on a standalone basis, the payoff here is massive, right? If our views on rates kind of hold, you can make those larger than just a pure hedge, right? It's a bit like, you don't want to spend too much money on insurance, otherwise it's too expensive to live in your home, right? You don't want the payoff on your insurance policy. Like if the storm comes, you collect $10 million for your $2 million home. You can't even do that today, but let's assume you can. But if the insurance if you knew that there was a storm coming, the insurance company was still willing to sell you that homeowner's policy at the same price as if there were no storm, you should overinsure. And so I think our only mistake there is we could have overinsured a bit more, because we knew a storm was coming.
You mentioned Netflix there, and my question to you is actually on a persistent mind. You said before in the show with Shane again that you're one of the most persistent people in America, and maybe your father might beat you to that, but you're one of the most persistent people. How do you know when to change your mind and when you are wrong?
The answer is, certainly a clue would be if new facts emerge which are inconsistent with the original thesis. And I think that's basically what happened with us with Netflix. So
does that happen often?
No, fortunately not. I mean, we get so much shit, if you will, when we make a mistake, because they're always big, right? We're concentrated. We're managing $15 billion. We're putting 10, 15% of our capital in any one investment. So if we lose, 25% on something where we have $1.5 billion, it's a $400 million loss. That will make the headlines, right? So we're going to get pummeled for it. So, every article I read recently about us is like, some investments we win big, some investments we lose big. The reality is 90% of the investments we've made in the last 20 years have been profitable. In fact, meaningfully profitable. We've had a handful, big blunders, big headlines, but they've been a small fraction of the what we've done. Otherwise, we wouldn't. The compounding doesn't work. We make a ton on this one, we lose a ton on that one. But the headlines imply, like, no one writes a story when we've owned a stock, we paid 12 for it, it's now 60, we've never sold it, so there's no visible gain or loss. That's restaurant brands. But no one writes a story that we've made, billions of dollars investing in that company, because there's nothing exciting about it. But if we lose $400 million in 3 months on Netflix, it's front page news.
Also, I think whenever someone's exceptional, they'll always try and bring you down in anything that you do. One thing, though, that was very apparent when I tweeted about you coming on the show, Bill, I had some of the most powerful people in finance privately message me and say, ask him why he's so public. And you said there about, people wanting to bring you down when there is an occasional loss. I would say that it's because you are very public, where maybe there are others in your case who aren't as public. Why do you choose to be so public?
So I would say originally it was a very important part of the strategy. We were a tiny fund trying to influence these really big companies, and we were using the power of persuasion to influence them. And we couldn't influence them with the fact that we owned 1% of company ABC, but we could if we corralled the other, substantial majority of other shareholders to our views. And therefore, having the platform, if you will, or the mouthpiece, was how we effectuated change. So it was a very important, powerful part of the strategy. And then I've always had this kind of free speech thing. I don't want to copy Elon or anything, but big believer in free speech. And if I think about the most important drivers in my life, I would say independence was always one of them. I did not like the fact that my parents could control me, and that motivated me to have lots of summer jobs, so I had my own spending money, and that also motivated me to be financially independent as promptly as possible. But one of the sad things about our country right now is I think free speech has been crushed to a great extent, other than if you're, if you can say something, if you could express a political view and get fired today, which is definitely a very real possibility, only if you're financially independent or, an entrepreneur of some kind, or you've got enough money in the bank, can you take the risk of speaking freely. So I take advantage of the ability to speak freely.
And even then, it's dangerous. Do you worry that? Because even then, it's dangerous. You see people like J.K. Rowling, a billionaire in her own right, who has bricks thrown through her window for free speech.
Yeah, that's a bad thing. I was speaking very freely this weekend, right, on the whole bank thing. I found, I've kind of become fascinated by Twitter in the last, I would say, 3 years. I really was not active on Twitter before that, and periodically active. And it's what I like about it is it's a way to have your views heard and debated. And, I'm, very meaningful number of people who matter in finance, media, central banking, whatever, follow me. And so, while Jay Powell probably wouldn't take my call if I called him to give him advice, because the last thing he wants to do is talk to someone who's actively buying and selling securities in a marketplace. Not that we are that active buying and selling, but I think he would certainly think of me as someone. I can share my view with Jay Powell directly. I'm quite sure he actually follows me, not under the name Jay Powell. He's got some other pseudonym. But my point is, it's an effective way to reach the people that matter in DC and otherwise about important policy things. And during the financial crisis, I did the same thing with the occasional PowerPoint presentation or segment on CNBC. But here I can, from the comfort of my couch, share a point of view on something that I think is important. And I was, woke up Saturday morning after the events of the week, pretty convinced that if the government didn't, at a minimum, guarantee deposits at Silicon Valley Bank, we'd have a massive run at pretty much every regional bank on Monday. And my advice was, we need to guarantee all deposits, not just those. And I think, unfortunately, the run is continuing. I mean, if you look at the deposit inflows at the big banks, if you talk to anyone at JP Morgan who works at opening accounts, they're working literally round the clock to take in all the capital that's flowing in. That's not good for our banking system in our country. And that was what I was afraid of over the weekend, which is why I was so public, if you will.
As someone who's just opened a JPM account and put all of my money there, I would certainly agree with you. It was not that easy to get time with them, actually, to be fair. We're going to get to that. I do have to ask, how much of your shorts on regional banks were driven by logic of social media viral contagion versus like fundamental analysis on the assets themselves?
So be super, super clear. We have never been short regional banks. We've never been long regional banks. And we were starting to look at possible investment opportunities. And then I decided on Saturday morning, and I sent an email to the team. I said, look, we're not going to invest in any of these banks because I want to be able to talk about this publicly without being accused of talking my book, right? And The unfortunate thing is, if you go on Twitter, however many people say, oh, he's doing this because he's long this, he's short this. We have no exposure, certainly no direct exposure. But I said, well, we have one big conflict, which is we're very long, America, right? If the financial system blows up, that's bad for markets. That's bad for the economy. That's bad for real estate. That's bad for, all kinds of things we're exposed to. So my conflict, if you will, is we're long America or American businesses, but I didn't want to be conflicted in terms of being short these stocks or not. So I have be super clear to your listeners, no exposure whatsoever to any of these banks or any of the big banks or any, the only financial institutions we own are Fannie Mae and Freddie Mac, which we've owned for years, which are kind of, if you will, options on a potential restructuring of those institutions years from now.
Bill, then you can help me if you're completely unconflicted. You came out saying there was real asymmetry in regional banks.
Yes.
My question was, don't they have the same risk if interest rates go up further on the mark-to-market value of their assets?
So the Silicon Valley Bank was, I would say, unique in the disproportionate amount of exposure they had to kind of long duration fixed income assets versus other banks. We've looked at First Republic Bank, which has been a underperformer, if you will, but its balance sheet, its loan portfolio, its business model looks very, very different from Silicon Valley Bank, but it's still getting shot, if you will, in the market, and that's because the government has still not given people assurance that every deposit is safe. And my point is, my overarching point is we need to get everyone calm. It's a bit like there were runs on mutual funds. I don't know if you remember during the financial crisis. One of the mutual funds broke the buck, if you will, like a money market mutual fund. People were redeeming, and they couldn't give people the dollar par, and that was causing a run on every mutual fund. Basically, the Treasury, Fed came in and said, look, we're going to guarantee principal at mutual funds, which is a pretty extraordinary thing to do, but it stopped people from withdrawing their money, so they could be comfortable. And then they put in new regulations about what money market mutual funds could hold, so the same problem would occur. I think basically the same thing has to happen with banks. First, you have to get everyone calm. So first thing to do is you guarantee deposits, okay, on a temporary basis, where that temporary guarantee stays in place until they update the FDIC insurance program to have greater than $250,000 guarantees per account, for business accounts, and people want to keep those kind of balances in banks. And then they update the regime, they charge for this insurance, and then they can get rid of this temporary guarantee at all banks. But if they don't do that, my expectation is, that people are still going to be concerned, and people like yourself are going to move from Silicon Valley Bank to the JP Morgans of the world. And
is Silicon Valley Bank not the safest bank to be at right now?
It is the safest bank. Actually, the irony is, and I tweeted about this morning, there's sort of two banks that now have an explicit guarantee regardless of how much money you put in those banks, right? That's Signature and Silicon Valley Bank. They have an explicit guarantee from the U.S. government. Then there's JP Morgan, there's Citi, there's B of A, maybe Wells Fargo, if you will, that are systemically important institutions because they've got, $250 billion plus, more like $1 trillion plus in capital. And those have the implicit backing of the U.S. government because we said, look, we're going to bail out those institutions if we need to, and we're going to monitor them more carefully. So those are probably pretty safe too. That's why people are putting their money there. And by the way, they tend to be run better, and they're, I would argue, probably overcapitalized today versus certainly where they were before. And then there's the rest of the banks which have $250,000 per account. And so we've created this now 3-tier guarantee system, which is very confusing to consumers. And the people who've been arguing that, moral hazard, capitalism is over. The problem with people losing confidence in deposits is the details get lost in the headlines, right? Once you hear you can lose money with a deposit at a bank, it affects everyone. And there were lines that people were lining up to take money out of their ATM machine, or go into their branch and get a check to move their money someplace else. I mean, this is like embarrassing for our country.
I was deeply I saw the videos on Twitter of people outside certain banks, and it was really unnerving. I've never seen this living in London. What does banking look like in 5 years' time? Do we just see the centralization of power to the 4 key banks, and the big 4 become more and more powerful?
Hopefully not. And there's there's a reason why a lot of people bank with these sort of smaller banks. And I'm in a venture capital fund, and the GP was asking my advice on what to do, and he opened an account at one of the big banks, and he was saying they don't know how to bank a venture fund, that makes a capital call and takes in 100 wires, and then needs to send wires here and there. That he found it very cumbersome already. So that's one important reason why we need these other banks. The service level can be a lot higher at a smaller bank. But I would say, if not more importantly, a lot of the construction lending and real estate lending and small business lending is done by these smaller banks. The big money center banks are not good at real estate lending. They've kind of gotten out of that business. But, commercial real estate is a major part of our economy. And you have these big banks that don't have a core competency making those kind of loans to developers, et cetera. And that will cause a meaningful slowdown if these banks lose all their capital and deposits.
Do you believe LPs are wrong then in pressurizing managers to move to the big 4? I'm obviously a manager, several $100 million under management. I have all of the big institutions who are saying, Harry, move the fuck to JPM today.
So the way you can manage this risk, firstly, I don't think you should keep a few $100 million sitting in a bank account ever. I don't care what bank it is. The discipline we've followed from the beginning of time, if you remember, we were betting against the creditworthiness of AAA rated institutions beginning in 2002, right? So I've been bearish on the rating agency's ability to assess creditworthiness for a long time. So the approach we take here is, other than cash we need for daily needs, we keep that number pretty small. Everything else is in a U.S. Treasury money market account, or we own U.S. Treasury bills directly. So we're not taking bank risk. We're just facing the U.S. sovereign. And then the cash we keep on hand, we do keep at a J.P. Morgan or at our prime broker, Goldman Sachs and UBS. And we monitor those institutions kind of very carefully. But actually, there's a case to be made for going back to Silicon Valley Bank now, okay, because you got a full faith and credit guarantee on deposits, and they're actually trying to, apparently they're saying they're open for business, they're making loans, they're doing whatever. But it's a bit of it's now a quasi-governmental institution. I mean, I think the right thing to do there is just to recap that institution. Again, we need a system-wide deposit guarantee, and then we need FDIC insurance with appropriate premiums so that these smaller banks can operate. That network of banks is important, for the farmer in Iowa as much as it is for the venture capitalists in Silicon Valley.
Does kind of wall-to-wall guarantees on deposits not just allow for constraints to be removed and bad performance and behavior to be allowed? So
again, we need a temporary government guarantee because we don't have a non-governmental insurance system to support it. Right? The FDIC system is not a government guarantee of deposits. It's a government guarantee in exchange for appropriate premiums. Right? The FDIC has $125 billion of premiums it's collected sitting in an account that's to backstop, insurance on deposits. It's a good system. The problem is that the amount of insurance available per account is very small, right? Small, not small for your average American's checking account, for sure. It takes care of that, but it doesn't take care of any kind of decent-sized business that has to have money on hand for payroll or working capital or otherwise. And you can't have, millions of small businesses trying to assess the creditworthiness of banks on a regular basis. And by the way, the creditworthiness can change dramatically. Silicon Valley Bank was a very solvent bank until rates moved a lot in 12 months.
Bill, if you were sitting in charge of the Fed, what would you do today?
I would call my colleagues at the FDIC and the Treasury. I would say, let's put in place let's announce to the world a temporary deposit guarantee on all deposits. Let's get busy quickly to create greater insurance levels, and let's get that system announced and launched quickly. It shouldn't take a lot of time, right? We already have a regime for $250,000 deposits. We just need to increase the amount of deposit guarantees that are available. We've got to first stabilize the banking system, and the Federal Reserve's principal job is financial stability. Without financial stability, we don't have any kind of stability, let alone U.S. dollar, U.S. interest rate stability. So once you go solve that problem, now Mr. Powell has an upcoming meeting where he's got to make a decision on interest rates, and each move of the lever, if you will, or each crank of the cranking up rates, puts pressure on the system and cracks emerge. And we've seen more of that crack. We've seen glass breaking. And so I think he's got to be very, very thoughtful about whether we raise rates here or whether we pause. And so I think there's a decent chance Powell says, we're not raising rates. We're witnessing, again, if they can stable, I haven't checked the news for the last couple of hours, but if even the form, here's an unusual thing. Sheila Bair was an FDIC chair in the Bush administration, or actually a while ago, maybe even Obama, Republican. She's in effect criticizing the FDIC for not having selective deposit guarantees instead of putting in a temporary guarantee, redoing the system. She's making my argument in today's FT that we need that to happen, because if that doesn't happen, all these deposits drain out of these regional banks. They're going to stop lending. If they stop lending, the economy is going to come to a halt, right? It's going to slow the economy very aggressively. So I'd be very wary about raising rates until we've solved this regional bank problem. And it's not just regional banks. It's people are going to start thinking about their small community banks and how solvent they are. There's a run. We can't have another bank closure. We have one more, and it's it's going to get messy.
What happens if interest rates go to 6% to quell inflation? Where do we invest then?
I don't think the Fed has to raise rates that much more. You're at a level today where certainly short rates are above or just above kind of underlying inflation. So we're getting closer to the financial policy slowing slowing the economy. My favorite approach, actually, the big problem we have is we've got, and that Powell's focused on, is I hate to call it even a problem, is we have full employment, very full employment, and we have rising wages, so those are starting to temper. The best way to solve that problem is to open up immigration, right? Why force people out of work to slow the economy to get rid of inflation? Why not increase the supply of workers so that we temper the increases in wages? I just think it's a better answer.
I had Dara from Uber on the show the other day, and he said his biggest concern is that actually the realization that Trump might actually get back into power, speaking of immigration. Do you think that's likely?
If it's Biden, Trump, I think Trump wins. But I think if Biden runs again, which sounds like it's approaching a certainty, I think it's a very interesting opportunity for someone who's not inside the political system to run for office on the Democratic side. My favorite version of events is Jamie Dimon, actually, believe it or not, a banker. I'd like a globally recognized, respected, talented business builder that understands the economy, that understands geopolitics, that has relationships with business leaders kind of globally. I think that kind of person, and also has a track record for caring about broad ranges of our citizens. I think that kind of person would make for an excellent candidate. So I'd love we're not going to see some senator or governor compete with with President Biden. But I'd like a better version of Trump, a better business leader to run for office, and I think they can absolutely get the Democratic nominee. And against Trump, they'll get the center and center right part of the Republican Party and can win.
Bill, would you ever do politics? You're very outspoken. People respect and follow you. Would you ever go into politics?
Someday, I'm open to it. Someday when my day job gets boring. I don't think my day job's going to get boring. I
don't think it's going to get boring soon, Bill. I'm going to be honest. Listen, I do want to move a little bit more personally to you. We've spoken about some of the great successes and also challenges. In terms of money, I oscillate on my relationship to money. It's a weird one for me. How do you analyze your relationship to money today?
I don't really think about it. So
you don't?
What do you mean? What do you mean by relationship to?
I used to think it was everything, and when I had 10 million, I'd be happy. Or when I had 20, I'd be happy. Or when I had whatever it was, that would be good enough. And then I would feel happy with that. And then I would be free. I wouldn't have to do any of this shit because I'd have enough money to not worry. And then it didn't happen. So I equated money to self-worth, money to power, conversation. People listen to you because you have money. Do you see what I mean?
Okay. So what's your question?
How do you think about yours today? Do you tie money to power, to freedom of speech, to presence and aura?
Sure. So what I would say is, getting back to my free speech, it is important to me. I like the fact that I don't have to worry about keeping my job and I can say what I think. Although my compliance person, every once in a while, I appreciate if before you tweet, please say something to me. So compliance is a little restraint on free speech. But, look, I feel incredibly fortunate. My ambition when I was 18, I was like, okay, I'm going to be really good at this business thing. I'm going to make a pile of money and I'm going to reallocate it the way I think makes sense. I've spent a fair bit of time, and I do, on philanthropic stuff. But I learned we've probably given away over $600 million in the last decade. And what I've learned from that is that philanthropy is often not the solution to many problems, and that business and for-profit business models are much more effective solutions to problems, most problems. And so, I think you get happiness. I think I've learned this over time. Happiness comes from helping other people, and I've spent good part of my life, finding people, spouses, and jobs, and introducing people to each other. And what money has given me is the ability to have, sometimes global impact on problems. And, so my day job of making hopefully good investments, and compounding the assets of Pershing Square for the benefit of our kind of shareholders and investors, which, hopefully improves their lives. And then, the profits that come from that, I certainly haven't more than enough to live my daily life. So I think about how do I reallocate those funds, often by investments, whether it's for-profit or non-profit investments that, my favorite investments are ones that are solve an important problem and they're profitable. The Pershing Square Foundation's actually made venture capital investments. We made like 15x, and the guy came to see us was trying to solve a societal problem in Mexico, things like this. So I would say I feel really fortunate. Independence, again, big driver. And I think financial resources give you independence. And I think if you have interesting things to say and interesting ideas, you have a voice. I don't know that it's driven by just having a pile of money.
Bill, I spoke to many of our mutual friends, and they said what a wonderful marriage that you have today. I wanted to ask, what have been your biggest lessons on what it takes to make a marriage work so well? Teach me.
Sure. So it starts with finding the right person, I would say. That's about 98%. You can choose the wrong person, and you can do all the right things, and it's not going to make for a great marriage. So I would say it's a lot in the selection, the mutual selection that comes from finding the right person. I just kind of come to believe, all these notions of opposites attract, and I'm not a big believer in that. Neri and I have a lot of commonality on, everything from drive, ambition, what makes us happy, values, thoughts on kids, parents, family, what's important in the world, physical attractions, obviously key. So we're just like super physically, intellectually compatible, and we're if you met her, you would say, okay, she's very different from you, Bill, but in very fundamental ways, we're pretty similar. So I think getting the match right is really, really important. Finding a authentic, super high quality, high integrity, interesting, attractive person, I think is almost, and then beyond that, it's making sure that your daily life doesn't distract you so much. You don't have time for each other, and that's a risk when you have two motivated people trying to accomplish a lot.
And yours doesn't? I mean, no offense. It seems from the outside that yours would do.
Well, no, I would say that's the biggest risk. And so we have to constantly make time for each other and find those quiet.
Do you do date night? Do you do Sunday evening walks? What's your thing?
So I think date night is a really important thing, and we need a more official implementation of it. We got married, and then we had COVID, and COVID was pretty amazing for marriage. Like, we lived in the same house. She worked upstairs in an office. I worked down. We met for lunch. We played with the baby. And at night, we would go on these 4 or 5 mile walks down the beach, even in the winter, with a flashlight. And it was a really cool, way to kind of get through COVID. And hopefully this summer we'll go back to that. We've not been doing that in the city, so I miss those kind of late night walks. And there was not much socialization, which is good in that if you spend an enormous amount of time with each other. But when you get back to, city life, and, you want to be supportive of the people, and you want to see friends and everything else. I think it's a massive time management problem. And so, Neri is building she'd be quite an interesting person for you to talk to. She's building an incredible company, hired, I would say, maybe 17 or 18, brilliant scientists, engineers, roboticists, biologists, and
I think we should do like an all-star Mr. and Mrs. I think that'd be a really fun style of show.
Cool. But she's, that's a pretty involved thing. And we've got, an almost 4-year-old child who means everything to, of course, both of us, but it's Neri's only child. It's tough, but you just have to find time. You can't hook up your life.
Can I be a really tough one? How do you bring up children in a world of, financial privilege, but also teach them to have the same drive, hunger, ambition that one would want any child to have growing up?
I think it's a very good question. I don't know the precise answer. A lot of people would say I grew up in a very privileged background. It's all sort of relative, but I grew up in a town called Chappaqua. We had a very good school system. My dad was a successful mortgage broker. We went on nice vacations, a nice house. I don't know that it matters so much whether you live in a $300,000 house or a $2 million house or a $20 million house, or whether your parents drive a Toyota. I think that the major differences are, you have access to a good education, you have food on the table, you have financial security. I don't know that it has to matter. What was interesting is, I remember kind of growing up, and I felt very, sort of fortunate with my upbringing. My parents told me they would be paying for my college education, but no more. That's what my dad's always sort of told me. And then we had actually some relatives or people close to the family who had a lot less than we did, and their kids were horribly spoiled. And I really think it's just the way the parents, raised the children. So I think it's all on the parents and kind of the lessons they teach about money. I never got an allowance. I had to work. I had if I wanted to have money to buy a Sony Walkman, I waxed cars. That's what I did. My dad said, "You want to make some money? Okay, dig that ditch." My first job, I got paid per hour, and I said, "This is kind of dumb." Next time I said, "Okay, how much do you want for me to dig the ditch? I'll do it." It's probably practicable, but I don't want to get paid by the hour. So you learn some pretty interesting lessons about money. But I would say it's in the parents. If the parents are kind of spoiled and wasteful and obnoxious, the kids will be too.
Sony Walkman. I remember getting a jog-proof one, the height of luxury. Listen, we're going to do a quick fire round. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Sure.
So what's the trend that most investors are not seeing or ignoring?
That there will be persistent, it's not a one-word answer, but the world is a structurally different place than it was for the last 20-odd years. And you're going to see persistent levels of inflation, 3 to 4% inflation for the foreseeable future. I think that's certainly being missed based on the pricing of long-term bonds. You can get it only about a 3.6% yield. I haven't checked my screens. It's probably so volatile, I don't know what it is today. But 3.6% yield for committing to the government, the government's only going to, borrow money. The government's borrowing money for 30 years at 3.6%. That can't make sense in a world where inflation is 3.5%.
What's the hardest element of your role today, Bill?
Time management.
What business models do not work in a zero interest rate world?
Everything works in a zero interest rate world.
Okay. Who do you look up to? Who do you admire? Many look up to you.
In my industry, I've been a Warren Buffett fan from the beginning. There's a guy who likes to remain private, but I'll mention his name, named Joe Steinberg, who is chairman of Jefferies, but built a company called Lucadia, who's had a lot of influence over me and over my career. I have a lot of admiration for my parents. My father was a very important mentor. It's someone I learned a lot from, and not always because he did the right thing. Sometimes he made mistakes, and I was actually, it's a big moment when you realize that that dad can make a mistake too. And my mom was the real activist in the family. Actually, she ran a campaign, collected signatures, and ultimately convinced the governor to give hundreds of millions of dollars to redo the rail system to our hometown. So I learned activism from mom. I would say those are a bunch of key people I've looked up to over time.
What's your favorite 10-year long?
If I can own a business for a decade, you're saying?
Yeah.
Well, I would say of the businesses I would say in an uncertain world, you got to own Universal Music Company, Universal Music Group, because the one thing I'm confident about is more people will have music subscriptions or be streaming music from whatever device, and lots of different devices with different use cases on a global basis a decade from now. And I think that's a certainty, and it's a very capital light business. And so I think that's a good place to put money for a decade.
What's your favorite 10-year short?
What's the name of that company? Probably shouldn't mention the name of the company. Forgetting the name, so I'm saving them. I probably don't want to out a public company, but there are businesses that are guaranteed to be disrupted by blockchain. that are old-fashioned, businesses that everyone hates because they're monopolists, and you can disrupt them with blockchain technology. So I would be short those companies.
What was the biggest takeaway? This one's from Jackie Reese's. She said, what was the biggest takeaway from the SPAC that didn't happen?
I would say I was very surprised. So we did a transaction with probably the best company that about any of them that merged with a SPAC, Universal Music. It was a super predictable, high-quality business. We buy at a very attractive valuation. We gave up our warrants, which were the only sponsor economics we received to do the transaction. We committed $1.6 billion alongside the public shareholders. And the transaction had some complexity because we had to accommodate tax and other issues of the counterparty who was selling their interest in the company. And despite it being great for the shareholders, despite our having exactly the same alignment with other shareholders, every other SPAC, there was founder stock and all kinds of other instruments. The SEC turned down the transaction for highly technical reasons, which substantively should be precisely the kind of transaction they're going to approve. And I guess the takeaway from that is sometimes, a lot government regulators focus on the technical details as opposed to high-level principles. And I think they could, you look at Silicon Valley Bank, just to close the circle, right? They made one of the most basic mistakes a bank could make, right? We had something called the S&L crisis in the 80s, right? Why? Because banks had a bunch of fixed-rate mortgages, and they had floating-rate liabilities, and rates went up, and a whole bunch of banks became insolvent. And so since that time, banks have learned to kind of have match funding, right? They have floating rate liabilities, so they should have either floating rate assets, or they should hedge their fixed rate assets for floating rate assets, or they should sell their floating rate assets as they create them. And here you had a bank that violated all the basic rules, and they're regulated by however many different control of the currency, FDIC, make your list of government regulators. And this is like one of the simplest high-level things that you should check about a bank, and somehow that was ignored by the regulators, and they had to be focused on a bunch of technical stuff. So I think the long answer to the story is, if we had principle-based regulation where people focused on the big picture, it would be way more efficient, and I think we'd have way fewer bad accidents.
Penultimate one. I'm worried about wealth terrorism. We hear about climate terrorism, the climate terrorists. I'm worried that actually people will start shooting down private jets style, and the inequality of wealth will be violent. Do you share that concern?
So I think wealth inequality is a big problem. I think there are ways to address it. And I think the key is, the analogy I would make is, one of the things the U.S. has done very, very well is promote home ownership. In fact, they did it a little too well going into the crisis, but in general, it's been a good thing. And our system of 30-year fixed-rate mortgages has enabled home ownership for a lot of people. And that's also created a lot of wealth. And the middle classes and homeowners, up through the financial crisis, while their wages weren't keeping pace, with upper income strata, they were making a lot of money in their homes. And then the financial crisis and over leveraging wiped out people's home equity. And I sort of view that as kind of the fulcrum moment when the wealth inequality issues really started to build. And I think the key is, people need to own a piece. And by the way, that started to rebuild in the last, since the financial crisis. A lot of people bought homes, recapitalized, and they built wealth in their homes. But the piece that a lot of people are missing out on is they're missing out on participating in the growth. That's the Tom Piketty thing, which is that, wages have not compounded at the same rate as assets. Asset compounding has vastly. So if you're someone who has assets that you have beyond what you need for your daily needs, and you can invest capital, you can build wealth. We need to give that to every American. And, compounding is this very powerful thing. So the New York Times did a piece on favorite ideas to help solve problems. My idea was, you give every baby that's born in America, a $7,000 account. I just sort of making up a number, $6,500 when they're born. And they can't remove money from that account, and it's tax exempt, and it compounds, and it gets invested in an index fund. If it earns, historic rates of returns in markets, by the time you're 65, it's $1 million. But it gives someone a minimum stake in the success of the country, of capitalism. It makes them an owner, right? By the way, that would cost $20 billion a year to do that. I think the math seems like a tiny little number. Today. Just take the number of babies times whatever, $7,000 or $8,000. It's like a nothing thing, but I think it would start to give everyone in this country a piece of the success of the country. So I think we need these sort of savings accounts, and we can't wait until people start creating an IRA or 401k by the time they're 25 or 30 or 35. You want to start when they're a baby, just because the laws of compounding. That extra 25 years is very, very material. So I think that's a key device to help address the problem. And I think we need smart tax policy. And there are lots of things we can do.
What is smart tax policy, Bill?
So there are a lot of things that make no sense to me. So for example, if you own real estate or certain other kinds of assets, you can do what are called like-kind exchanges, where you can sell an asset, and you pay taxes, or you can exchange it for another asset, right? And you don't pay any taxes. It's a total joke. It's like a gimmick. It's a complete giveaway to people in real estate. There's so many, if you're a dedicated real estate investor, you can pass through, like President Trump, you can pass through the depreciation on those real estate assets and offset your other income, which is why Donald Trump didn't pay taxes pretty much his entire life. For things like that are easily fixable. Here's another one. So if you're Elon Musk, right? I'm not a believer in wealth taxes, but if you're borrowing $5 billion against your Tesla stock, and you've borrowed more than your basis in the Tesla stock, I think the distribution from that kind of borrowing should be taxable, because it's really tantamount to a sale. You're getting back more than the money that you invested. That should be, when you refinance a piece of real estate, commercial real estate, if you buy an apartment complex for $100 million and it goes in value to $200 million, and you refinance the mortgage and you take out $50 million of proceeds, I think those proceeds and excess, should be treated as a taxable
But Bill, this is highly logical and very much in vogue of kind of leftist regimes which are in power. Why do they not do it?
By the way, I think the Elon Musks of the world, I think would support this kind of tax. It makes sense. The problem with the wealth tax, if you got the Biden wealth tax, which is like 25% of the appreciation of things that you own privately, it's going to bankrupt every startup. No one will ever start a business in America anymore, right? Because no one will be able to. What do? You sell God forbid someone puts money in your company at $1 billion valuation. All of a sudden you owe, if you own half the company, you owe $100 million in taxes that year. Those kinds of taxes, I think, are, destructive. You don't want to have a tax policy that destroys the economy, right? You want to have a tax policy that makes sense. But there's certain things that are just wrong and unfair, and they just persist. Like, by the way, carried interest, which I've said my piece on for a long time. Giving someone a disproportionate share of gain is a very powerful thing to drive economic behavior. But I think differently about the real estate entrepreneur, the oil and gas entrepreneur, building a business, than us folks in the asset management industry. I don't think we need that extra tax advantage, i.e. carried interest, when you're managing assets to motivate our economic behavior.
Are you scared of anything you see in the economy today?
Am I scared of?
Anything you see in the economy today?
Sure. I don't use the word scared, but I would say there are many reasons to have concern, right? We've got the North Korean situation. We have Ukraine, Russia. We have China brokering a Saudi Iranian rapprochement. And now China's becoming that stuff the United States used to do, right? We have Russia crashing, their planes into our drones. We have China with its eyes on Taiwan. We have the United States draining its strategic petroleum reserve and draining its weapon resources when it's doing the right thing in supporting Ukraine, but it should be giving, our Defense Department should be giving orders to all of our defense companies to rebuild our weapon stocks so that we're not out of inventory in a highly uncertain world. We have, Chairman Powell, Mr. Powell has got his job has become a lot more complicated in the last 4 days, right? We have real serious inflation in our country, and we have, financial instability. and he's got to work with his colleagues at Treasury and the FDIC to stabilize the banking system. And I have a really simple solution. I've laid it out a bunch of times, and hopefully my laying it out won't discourage them from doing it. But we've got a lot of, and then we have, the political divisiveness, and then social media companies that can generate more attention by driving us to the left and to the right. Right. So what we need a Facebook that motivates us to love each other instead of hate each other. That would be someone should build that company.
I've invested in it.
Is it one of your losers or winners? We don't know yet.
We don't know. The joy of being a pre-seed and seed investor, my friend. Is America stronger or weaker in 10 years' time?
I have to say stronger because I'm an optimist. Everything bad, good will come from it. Good will come from this war with Russia for sure. It's already, some good has come. Good will come from the wake-up call we've had with Silicon Valley Bank. And hopefully someone's motivated to run against Biden and Trump. That's, we need some more white swans. We've had too many black swans. Or a good black swan would be we resolve Ukraine-Russia in some form. Russia just backs off, or there is a peace resolution there. And we elect an outstanding leader that there's common appreciation for, that kind of brings us together. I'd love to see that happen.
Final one, Bill. We do this again in 2028, so 5 years' time. Where's Bill then?
Hopefully a better, more improved version who's learned from whatever mistakes I made in the previous 5 years.
Is Bill in politics then?
Who knows where the world takes us? I have no idea.
Listen, I've loved doing this. Thank you so much for putting up with my prying questions. You've been amazing, and I really appreciate it.